Our next guest thinks we've seen the bank's final hike, predicting a recession on the horizon with rates staying high for the foreseeable future. Joining us at Post 9 Bleakley Advisory Group CIO Peter Boockvar. It's great to have you, Peter. Do you think this is about supply in the short term?
So I'm going to add to that because I think a lot of it is. Because if the economy starts to slow, tax receipts start to slow. And we have an 8.5% budget deficit as a percent of GDP with still a 3-handle on unemployment on a trailing 12-month basis. At the depths of the 2008 recession, it got to 10%. So you have this enormous. So if you go into recession, you're going to see a double-digit budget deficit. Now, for 40 years, budget deficits didn't matter. They kept rising. People were in the mid-'80s were complaining about all the government spending. It didn't matter. But maybe this time it does matter because of the supply, of the potential reduction in tax receipts. You have QT, not just in the U.S., but globally. You have the BOJ move. You have banks that are not buying, foreign central banks that are not buying. So there is the potential for a clearing price in the 10-year that is higher than it is today. And Rick talked about the incongruent nature of today's move, where you had this weak payroll number in some analysis, and you have this jump in the 10-year. That, to me, is telling that there's something going on here, and that just as we're getting comfortable that the Fed is done raising short-term interest rates, we get this rise in long-term interest rates.
So, and then, of course, if the rates go higher from here, what does that mean for the overall interest payment for the government, and kind of it becomes more of a self-fulfilling prophecy?
Exactly. Interest expense at the government level heads to $1 trillion, starts crowding out other things. I mean, that's the risk to the economy right now is the government crowds out private sector finance. I mean, you talk to friends, hey, I'm going to buy the 2-year. Well, that's money going to the government as opposed to going to the private sector. So there is that risk that also is a self-fulfilling prophecy as well.
So that kind of, I mean, when Rick says a sniff of stagflation, doesn't sound like it really collides with that point of view, right?
Well, the good thing is inflation definitely moderating, but here we are. The oil prices are at a 1-year high, $85. That sort of complicates the job of the Fed, keeps inflation potentially higher for longer. And with inflation, there's one thing to see a deceleration in inflation to get to that 1% to 2% goal of the Fed. There's another thing to keep it there.
Yeah.
I don't think it stays there.
Because of energy?
Well, no. I mean, that's just one piece.
Right.
But goods prices are not going back to its 20-year trend pre-COVID of 0 for a variety of secular factors. So, yeah, we may see a 2-handle in inflation, but that's not achieving the Fed's goal. It's keeping it there that does. And I think 3% to 4% is the new inflation normal in the next couple of years.
I want to ask you about hedge fund positioning, not to get too wonky on this summer Friday, but the Fed put out a paper this week on the basis trade, which essentially means that there's a pretty significant trade out there that's short Treasury futures, long Treasury cash, and borrowing in the repo market to finance the trade and produce leverage. And the Fed basically says that it presents a financial stability vulnerability because the trade is generally highly leveraged and exposed to both changes in futures margins and changes in repo spreads. Given some of the volatility we've seen even today in the rates market, how concerned are you that this risk of leverage is getting to the point where it becomes more dangerous and reach more of a critical threshold?
Well, whenever I hear about that, I remember what in 1998, long-term capital management, they had these basis trades. They were trying to arb different interest rate positions and with a lot of leverage. And, yeah, you always have to wonder when that has to unwind. But
well, it happened in March 2020 as well.
Right, when foreigners were massive sellers of U.S. Treasuries in order to get dollars in what was sort of a panic situation that brought the Fed in. So the thing about the Treasury market, on certain days it trades like a meme stock, which is a scary situation.
It's supposed to be risk-free.
It's supposed to be risk-free and the most deep liquid market there is. And also you have the banks that are not making markets like they did pre-Volcker rule. So it does add some risk for sure.